Good afternoon, traders. It's going to be a fascinating Reserve Bank meeting. I think we've got to look at the balance of probabilities playing through. The first point I'd take is that the implied volatility in the Aussie dollar over the coming week is sky high. 14.7% is 1 week implied vols on the Aussie dollar. That's the highest since February 2021. It's the 90th percentile of the 12-month range. That gives an expected move with about a 68% chance or probability that we see about a 120 pip move in the Aussie dollar up or down. The market's expecting movement in the Australian dollar. Certainly Aussie yen vols are very high at the moment. That has big implications for how much risk we're taking on. It has big implications for our position size and whether we want to hold exposures over this meeting. The market is expecting super volatility to be playing through. In terms of positioning, well, I think there's probably some scope for the Australian dollar to squeeze. I mean, certainly our clients are long Aussie dollars at the moment against the greenback, more probably a US dollar play than anything else. But if you go into the broad market, the market is short of Australian dollars. We've seen that asset managers are certainly short. We're certainly seeing that from leverage shorts at the moment in the TFF report. And I think from that perspective, there is some room to squeeze a little bit higher. Where we see downside is in the rates pricing. Okay, the Aussie dollar, if you look for rates pricing for this meeting, is pricing at about a 17 basis point hike. That's in line with the consensus from an economist at the moment. But if you go into the June swaps or rates pricing, you see 37 basis points of tightening being priced in that step up. That's a 50% chance of a 50 basis point rise, which I don't think is going to happen. Fine, I think between that period, we're going to see the wage price index, we're going to see the employment data, we're going to see the national accounts on the 1st of June. But of course, 37 basis points in my eyes is too rich. So will the statement justify that pricing? We can also go into the full year and see 250 basis points or 10 rate hikes being priced in. That takes us well above the neutral rate of 1.7%. So again, going well into restrictive territory. Will the statement justify that? I'm not so sure that's going to be the case. So while positioning is certainly short of Australian dollars, we see that rates pricing, in my opinion, looks a bit rich as well. So there's a whole multitude of factors that need to play into this. Technically, the Australian dollar looks like people want to sell into any kind of rally, certainly against the yen and against the US dollar. But a very lively affair indeed. Will the statement justify this rates pricing? The market seems to be short on this, but will save the day.